Welcome to the Deep Dive. We're here to cut through the noise on the latest earnings calls and give you the insights that matter fast.
That's right.
Today, we're jumping into Ryan Specialty Holdings, ticker YN, and their Q2 2025 earnings call.
Yep.
It's a dynamic market out there, so really understanding the story behind the numbers is, well, it's crucial.
Exactly. And look, Ryan Specialty definitely showed some strong execution, operationally speaking, solid quarter in many ways.
Right.
But the market reaction, it wasn't quite the standing ovation you might expect from just looking at the headlines.
Yeah, you'd think so with some of these figures.
Precisely. So there's a bit more nuance here, and we're going to really unpack what was driving that sentiment, what it all means for them going forward.
Okay, let's do it. Let's hit those key figures first. Q2 2025. Total revenue came in at $855.2 million.
Right.
Now, that's a pretty hefty 23.0% increase compared to last year. And importantly, it beat the consensus estimates.
Yeah, it beat them quite nicely.
And their organic revenue growth, the growth from their existing business, stripping out M&A that landed at 7.1%, still solid.
Still solid, yep.
Yeah.
And then you look at adjusted EBITDAC.
Right, their core profit measure.
Exactly. That hit $308.4 million. That's up 24.5% year over year.
And the margin.
Healthy, 36.1%. That's an expansion of 50 basis points.
Okay. Margin expansion is always good to see.
Absolutely. Shows discipline. Adjusted diluted EPS, earnings per share, was $0.66, right in line with what analysts expected.
Okay.
GAAP EPS was $0.38, and they also returned about $21.9 million in dividends to shareholders.
So strong top-line beat, margin expansion, EPS in line. Sounds pretty good on the surface.
It does, but like you said, the market reaction was more, let's call it cautious constructive.
Cautious constructive, okay.
Yeah, investors were definitely looking past those backward-looking numbers and focusing more on shifts in the company's outlook, their guidance.
The guidance. That's usually where the story takes a turn.
Often is, and that's what we need to dig into now.
Okay, so let's unpack that 23% revenue growth. How did they get there? It wasn't just one thing. Right?
Yeah, not at all. It was really a combination. You had that organic piece, the 7.1%.
Right.
But a really significant chunk, 13 percentage points of that growth came purely from recent mergers and acquisitions, M&A activity.
13 points from M&A. Okay, that's substantial.
It is. And then on top of that, they got a nice little boost from contingent commissions.
Explain those quickly.
Sure. They're basically like performance bonuses. Ryan gets them from their insurance carrier partners when the business Ryan places performs really well, meaning low losses for the carriers.
So it reflects good underwriting by Ryan's partners on the business Ryan brought them.
Exactly. It's a sign of the quality of the business they're placing.
Got it. So organic growth, M&A, and these contingent commissions, but there was a big but, wasn't there?
Oh, yeah, a major headwind. And what's fascinating, or maybe concerning depending on your view, is how strong it was despite those tailwinds. We're talking about the property rate environment.
Property. That's a good story.
A big one. Q2 is typically Ryan's biggest quarter for property business. And rates didn't just soften, they fell quite sharply.
How sharply?
Well, think about it this way. In Q1, the talk was about rate reductions, maybe in the 10-20% range.
Yeah.
In Q2, that accelerated pretty significantly to reductions averaging 20-30%. And they specifically mention it got worse in June.
20 to 30% reductions. Wow, that's a rapid shift downwards.
It really is. And that directly feeds into why they adjusted their guidance. That cut in the organic growth outlook, even though it looks like just 2 percentage points.
From 11-13% down to 9-11%.
Right. It seems small, but it's actually a pretty significant signal. It tells you management sees these property headwinds as, well, stronger and maybe sticking around longer than they first thought.
So they had to kind of reset expectations.
Exactly. It shows how even a strong player gets buffeted by these big sector shifts. And investors, they often react more to that future guidance than the past performance.
That makes sense. So that property pressure really highlights the contrast with their other big segment, casualty, right?
Absolutely. While property was, facing these headwinds, the casualty side of the house actually had a very strong quarter, really resilient.
That drove that.
They pointed to really excellent new business wins and very high renewal retention. And that was across a lot of different areas, too.
Like what?
Transportation, habitational risks, think large apartment complexes, public entities, healthcare. quite diverse.
So good diversification within casualty helping them there.
Definitely. And if you connect that to the bigger picture, the casualty market overall is still very firm. This isn't just, a temporary thing.
Why is that? What's keeping casualty rates firm?
It's a few things stacking up. You've got difficult loss trends continuing. You've got social inflation.
That's the rising cost of claims from things like bigger lawsuits, right?
Exactly. Bigger jury awards, more litigation that pushes claim costs up. Plus, you have wider economic factors. All this makes insurance carriers nervous.
So they raise rates and pull back.
They raise rates and they reduce their appetite, meaning they become pickier about what risks they'll cover in the standard market. And guess where that business goes?
To the excess and surplus market. To players like Ryan.
Precisely. So management sees what they call a long runway for sustained casualty pricing. These trends aren't going away quickly.
Okay, so here's a key point then. Even if property prices are falling,
Right.
the actual amount of complex business flowing into the E&S market, including for property, might still be strong.
That's the crucial insight. It's about the flow of risk. The volume of complex, hard-to-place business keeps coming into the E&S channel because the standard market doesn't want it or can't price it effectively.
Even if the price per policy is lower for property right now.
Exactly. So the E&S market isn't just about rate hikes. It's fundamentally about handling complexity. That's a structural tailwind for Ryan, kind of independent of these short-term pricing swings in one segment.
Got it. Okay, let's shift to strategy. They've been busy on the acquisition front, too.
Yeah, they definitely haven't been sitting still. They mentioned closing a couple deals in Q2. USQRisk, they're in alternative risk solutions.
Okay.
And 360 Degrees Underwriting. That's an MGU based in Ireland, focused on commercial construction. An MGU is like a specialized agent that can underwrite and handle claims for an insurer.
Right, delegated authority.
Exactly. And then just after the quarter ended, in early July, they closed another one. J.M. Wilson.
What do they do?
They're a binding authority firm, big in transportation. Binding authority means they can commit an insurer to a policy quickly. Adds about $19 million in annual revenue, they said.
So these are all about expanding reach, getting more expertise, and boosting that delegated authority.
Spot on. Building scale and capability.
And there was that big strategic alliance announcement too, right? Just nationwide.
Yes, that was a major point on the call. A significant deal. Ryan Re, which is their reinsurance MGU,
Okay.
is going to become the exclusive reinsurance underwriter for Nationwide, specifically for the renewal rights Nationwide bought from Markel.
That sounds like a big integration piece.
It is, and it means Ryan has to invest heavily in bringing on top talent in the second half of this year, 2025.
Which impacts margins short term.
Right. It'll put some pressure on margins temporarily, but, and this is key, they expect it to be margin accretive by the first half of 2026.
Meaning it'll boost margins after the initial investment phase.
Correct. It's a strategic long-term play. Invest now for bigger gains later.
Makes sense.
Yeah.
And they also mentioned investing in their alternative risk business.
Yeah, Ryan Alternative Risk. Pouring money into talent and intellectual capital there, too. Developing new, innovative ways to handle really complex risks for clients.
So more long-term growth drivers.
That's the idea, planting seeds for the future.
Okay, so putting it all together, the property headwinds, the strong casualty performance, these strategic investments, that all led to the guidance recalibration.
Exactly. That's the context for the revised full year 2025 guidance. Organic growth cut from that 11-13% range down to 9-11%.
And the margin guidance trimmed too.
Just slightly. To 32.5-33.0% for adjusted EBITDAC margin. And management was pretty clear. It's mainly because they expect those property price declines to stick around, plus the impact of funding those strategic investments we just talked about.
Right, and they even expect their overall property book to shrink modestly for the full year.
Yeah, they noted that, which really underscores just how tough that property market pricing is right now.
Yeah, hearing about those steep property rate declines, I was kind of bracing for a much gloomier long-term view from them.
Yeah.
But then reading their comments, here's where it gets really interesting for you. They still sound quite optimistic long-term about property. Why? What are they seeing?
That's a great question, and it really gets to the heart of their long-term strategy, Despite these current pretty painful price drops, management is still optimistic about the long view for property, and they point to some pretty fundamental reasons.
Oh, like what?
Well, first, look at catastrophe losses. They've been over $100 billion globally for, 6 years running now?
6 years. Well,
That puts immense pressure on traditional insurance capital. Second, you've got the rise of what they call secondary perils.
not just the big hurricanes, but wildfires, hail, floods.
Exactly. Things that are maybe less predictable but add up to huge losses in aggregate. And third, simple demographics. More people and more valuable property moving into areas prone to these catastrophes.
So the underlying need for coverage in risky areas keeps growing, regardless of short-term price swings.
That's the argument. These are deep structural factors supporting the need for E&S property solutions over the long haul. It's like, well, the current pricing is tough, a bad season maybe, but the fundamental need for specialized capacity isn't disappearing. If anything, it's growing.
Which brings us back to that flow versus rate idea you mentioned earlier. They stress that E&S growth is more about the flow of business coming into their channel than just rates going up or down.
Oh.
How does that square with property rates falling 20-30%?
It's a critical point for understanding how E&S works. Even with property rates declining in Q2, they said the flow of business, the actual volume of submissions and policies needing placement in E&S remains strong across all their lines, including property.
So more complex risks are still being pushed out of the standard market into E&S, even if the price for that risk is temporarily lower.
You got it. Because standard carriers are still reducing their appetite for volatility and complexity. So Ryan might get less premium per property policy right now, but they could still see more policies flowing in overall. The need for the E&S solution persists. That flow is the long-term driver, more so than just the rate cycle itself.
Okay, that makes more sense.
Yeah.
Something else I noticed was management making a point quite strongly about being aligned with their capital providers, the insurers whose paper they write on in the MGA model. Why emphasize that now?
Good catch. That speaks to a potential friction point in the MGA world, especially when the market softens like it is in property.
What's the potential friction?
Well, there can sometimes be a perception or criticism that maybe an MGA's incentives aren't perfectly aligned with the insurer carrying the ultimate risk. Like maybe the MGA is focused on commission volume, while the insurer is worried about underwriting losses when prices fall.
I see. So Ryan was pushing back on that idea.
Forcefully. They were basically saying, look, our interests are aligned. We invest heavily in our platform, data, talent. We practice strong underwriting discipline. We're building sustainable value together for the long term, not just chasing deals. It's about reassuring investors and, importantly, their carrier partners that they're managing the business responsibly through the cycle. Crucial for confidence.
Understood. So despite these near-term headwinds, they're sticking to their guns on the long-term target.
Absolutely. They reiterated their commitment, aiming for double-digit organic growth and hitting a 35% adjusted EBITDAC margin by 2027.
35%, that's ambitious.
It is. But they expect the benefits from these current investments, the nationwide deal, the alternative risk build-out to really start kicking in during 2026, paving the way towards that 2027 goal. It shows real conviction in their model and the E&S market's structural advantages.
Okay, let's pivot to the market reaction. You said cautious, constructive. What actually happened to the stock?
Right. So after the earnings came out, from the close on July 31st to the close the next day, August 1st, Ryan shares dropped about 5.5%.
Okay, a noticeable dip.
Yeah, and it happened on really heavy volume, too. About 5 million shares traded, which is way above their typical average. A lot of people reacting.
So why the drop if the quarter itself beat revenue estimates?
It really boils down to that guidance cut on organic growth and the commentary around the property market. Investors focus heavily on those forward-looking signals.
The near-term headwinds overshadowed the Q2 beat.
That's basically it. Even with management stressing resilience and long-term strategy, the immediate concern was about how tough that property rate environment looks for the next few quarters. And remember, this isn't happening in a vacuum. We're seeing signs of softening property and reinsurance pricing globally.
So it's partly a sector issue, not just a Ryan-specific thing.
Correct. But Ryan, given their significant property exposure, is certainly feeling it right now.
All right, that brings us to our not financial advice segment. Time for an outrageous but maybe plausible idea.
Okay, here we go. And let me stress again, this is absolutely not financial advice, purely a thought experiment. Do your own homework.
Loud and clear. What's the idea?
So look, management's guidance seems pretty conservative on property rates, right? They're baking in those 20-30% declines persisting.
Seems that way, yeah.
But they also keep saying these low rates aren't sustainable long-term given loss trends.
Right.
So here's the trade idea. Consider a long-dated, out-of-the-money call option on Ryan. Maybe 18 months, maybe 2 years out.
Okay, betting on a recovery. What's the specific trigger?
The thesis is you're betting against that conservative guidance. You're betting on a significant, earlier than expected reversal in property rates. Maybe it gets triggered by an average, or heaven forbid, worse than average hurricane season this year. Or maybe just the continued grind of those secondary peril losses forces rates back up sooner than people think, say, late this year or early 2026.
And if that happens,
Then Ryan's 2026 organic growth could come in way ahead of the currently subdued expectations. A big positive surprise.
combining a rate turnaround with the benefits from those investments kicking in.
Exactly. That positive surprise from property rates flipping would land right alongside the expected accretion from the nationwide deal finally showing up in the numbers, plus whatever comes from the alternative risk investments. That combination could lead to a really powerful re-rating of the stock. The market realizes the guidance was conservative, not a sign of deeper problems.
So it's a bet on the cycle turning faster than expected, amplified by their strategic moves paying off.
Precisely. It's definitely a high conviction swing, low probability in the near term, maybe, but potentially high payoff if that property market snaps back hard and catches people off guard. Betting against the current pessimism.
Interesting. A classic contrarian play based on the insurance cycle.
You could say that. Again, not advice, just an idea to mull over.
Got it. Okay, let's wrap this up then. Key takeaways from Ryan Specialty's Q2.
Well, they delivered a pretty resilient quarter financially, beat revenue, expanded margins slightly.
But the revised guidance clearly signals near-term pain from that rapidly softening property market. That's the big headline.
Right. But you've also got the counterweights. Their strategic investments are significant, the nationwide deal is a big one, and their casualty business remains very robust. Those are the foundations for that longer-term growth story.
And they're sticking to that long-term outlook, double-digit organic growth, and aiming for that 35% margin target by 2027, despite the current choppiness.
Yep, they're playing the long game, navigating the current cycle while building for the future.
Okay. And one last time, nothing we discussed here constitutes financial advice.
Please, do your own research.
Thanks for tuning in to this deep dive. We hope unpacking the Ryan Specialty call was useful. Definitely continue your own due diligence. Maybe think about what stood out most to you from this discussion about navigating such a complex market.
Yeah, lots to think about.
We'll catch you on the next deep dive.